geez, we started all quarter.
I'm like holding it, like even this whole day I'm dreading it still.
I had one today, and that's really good. I don't feel like I did that. I'm too shy.
The cloud is up there. All right, this is accounting 426, fall 2016, right? Today it'll be one problem from chapter 11, so that's acct 426Ch11, and problem, I think it was 41, if I remember correctly. Forty-three. The end of the passive activity losses. What are you doing? You have multiple passive activities. And then we'll go into the lecture for chapter 7. So that'll be ACC.
Are you going to do the problem you said about chapter 6 about the qualified statistic?
There's one problem left. Yeah, probably won't do it today. ACCT 426 chapter 7, right? Lecture, LEC, and probably probs, right? We're going to try to get into the problems from chapter 7 also. And those will be problems 37, 38, 28, 31, 33. I might start with 28, 31, 33, then 37, 38. Yeah, there was a question. There was one problem still left from chapter 6 on qualified business income, which is something new in the 2017 law. It was problem 37. We haven't done that one yet. Today is Monday. Wednesday we'll be into chapter 8, all right? Our last chapter for this second exam. There'll be lecture on Wednesday and probably the exam preview for 6, 11, 7, and 8, right? On this 10-week version of the course, 4 chapters per exam. So 6, 11, 7, and 8. When I do the 5 or 6 week version of the course, the first exam is just about everything we've done so far, not chapter 8. It's 1, 3, 4, 5, 6, 11, 7. They have 2 exams only. All right, I'll pass around the sign-in sheet. So we'll do that chapter 11 problem and then off to 7 today. And then Wednesday, 8, and the exam preview, right? The exam is a week from this Wednesday. So next Monday, we'll clean up those problems, right? I'll do whatever problems I think would help you the most. It'll be mostly chapter 8 problems, right? They add new material to the course, and I have to decide what to add and what to cut, right? We were taking all those videos that we made so far, right, and making sure that they were at least available to the students in the online class, right? There's a 5-week online starting today. All the videos we've been making here, right? Yeah. They still need a lot of touches to them, but at least as they were recorded in class, they're now available. All right. Seven is probably an easier chapter, right, comparatively for most students. Yeah, 11's a hard chapter, passive activity losses, right, difficult material. You can tell sometimes that some of these chapters are, and that's why I have less time allotted, right, for covering 7. Today is the 29th as we're recording here, October 29th. Please sign in with your full name next to your name. I know when we were last working problems, we were working across the back of the room back there. We're almost ready to come back to the front where we started. All right. You can take a look at this if you're interested. Somebody on campus is doing a study on parents that have to have 2 kids in a certain age group. You know, so if you fall into that category, I guess they're trying to see how the children affect the parents who are in college, right? They want to see if you want to participate in their study, and offer you an Amazon gift card. When I get stuff like that, you know, the job opportunities, whatever, I try to pass them around to you. All right. Our older son, his birthday is tomorrow, right? The younger one was 3 weeks ago tomorrow. Exactly 3 weeks short of 10 years apart, right? Yeah. So the younger one just turned 7. The older one's going to turn 17. So we'll have a dinner with him tomorrow. I think he'll go off with his friends on one of these weekends to, which one is it? Knott's Berry, I think they want to go to. All right, when we were last doing problems, it was the 24th. We were in the back there. Who hasn't had a problem in the back yet? Who has not done a problem? Everybody's done a problem back there? All right, let's see. Where is Yesenia back there? Okay, you haven't had a problem yet? Okay, you'll probably be next here on my sheet. Okay, and let me get everything up and running here, right? Okay, what we're doing today, right? We have chapter, I got a green pen right now. Chapter 11, problem 43 to do yet. That's our passive activity loss chapter, as was mentioned up here, probably a harder chapter. Then we're going over to chapter 7, right? It's titled Certain Business Deductions, although there's more than business deductions in there. And I mentioned those problem numbers to you. Put them up here. 28, 31, 33, probably do those first. And we'll see if we can get to 38 and 37. Okay, and I do need to do a lecture right before we get to the problems. Okay. In the back of the room, Senia, today's the 29th. All right, if you would please go to chapter 11, problem 43. Chapter 11, 43, and read that if you would please. All right, they give us a list there, right? They tell us these are passive activities, A, B, C, D. And we have what, a plus 30, a minus 30, a minus 15, right? And a minus 5, okay? And then what do they ask? Go ahead, or what do they say, please?
In the current year, she sold her interest in activity B for a $10,000 gain. Activity B, which had been profitable until last year, had a current loss of $1,500. Under the following questions to determine how the sale of activity B affects their taxable income in the current year.
All right. So if we got all the data here correctly, they sold D at a gain this year, right? They talk about this year and last year in accounting, and that was last year's data on the 4 activities. And this year they sell D 10,000 gain. D had an operating loss this year of 1,500, although it had been profitable in other years. Let's see, how will it attack in the current year? Until it was profitable until last year when it had that loss. All right, and it says, how will the sale affect? All right, we're wondering, Yesenia, how we can use, right, that $10,000 gain and that 1,500 operating loss. Don't we have to go back to last year and figure out how much loss was carried forward? The suspended passive loss, right? If we only had D in the prior year and that was our only activity, that would be the loss, right? That is suspended and carried forward. But now we have several here. Do we add these all together, Yesenia? All these are, they said these were all passive. If we added them all together, we'd have what, a negative 20. Do we do that? Is that the first step? It is. It is. That is the first step, right? Some people will forget that, right? The regulations, remember again, the IRS wrote those regulations. Step one, we call that the hodgepodge or the hodgepot. You take all these passive activities, you add them together. All right. We have one passive income activity and 3 passive losses. We have a net passive loss. Now, where is that net passive loss, Yesenia? Is it on C and D? Those add up to 20,000. Or do we have to allocate that loss? To which activities? All right. How did you come up with that? You say it's 2,000 on D. How did you come up with that? By a ratio, isn't it? You go to the loss activities, right? 30, 15, and 5. They add up to 50. So then it's 30 over 50, 15 over 50, and 5 over 50, right? That's how you got that 2,000, right? 10% of the 20,000 loss added or allocated, I should say, to D. And then 15 over 50 would be what? That's 3 over 10. So 30% of 20 would be -6. And then 30 over 50 is 60%. So that should be 12. 60% of 20. That adds up, right? There's our losses allocated to the activity. You have to do this whenever you have more than one, right? Because if you only had one and the loss is suspended because you couldn't use it, didn't have enough passive income, it's suspended attached to that activity. But if you have more than one, well, then you've got to go through this allocation, right? It's suspended and carried over to a future year, right, Yesenia? When can you use those losses in the future year? What's the rule on that? When can you use a suspended loss? Loudly, please. Can you always use it the following year? You have to have what? Income, a passive income from that activity, right? In that future year. Or what else? Disposal, right? Which would, it turn, when you dispose of it, as happened here with D, right? It turns the suspended loss into active, right? So yeah, thank you. You can use it against anything, right, Yesenia? Now, I think their model answer on this actually does it according to the regs. Because now we're in this year, right? We've got that 2,000 carry forward, and we've got the 10 gain and the 1,500 operating loss. There's an order, right? Now, how about that 10 gain? Is that passive income? Is that passive income? You sell a passive asset. Remember when I went over that problem, I said they were missing a bullet point? It was one of the problems at the beginning of the chapter, or when I gave you the list at the beginning of the chapter, I said they're missing, and it was also the beginning of the problems. Number 4, active passive portfolio, and I said they're missing something here under passive. They forgot to tell you if you sell a passive activity, it gives you passive income, right? It's used first against this activity, and which of the losses first, the carry forward or the operating? I think it says, what does it say? And I think their model answer is correct. They go to the carry forward loss first, then the operating loss, right? In any event, we end up with what? A net -65, right? On this activity D, right? No, positive, excuse me. Oh, now I got to get my eraser, right? That's a positive 65, isn't it? There we go. Positive 6,500, which is really passive income. Got a passive income generator now, right? Now that was last year. If we assume the other activities were the same for this year, well, then we say A's at 30, B's at 30 loss. A's was income. C's at a 15,000 loss. And D we took care of already, right? Well, then we'd have what? A net -15, wouldn't we, right? Do we put that 6,500? How about that, Yesenia, into that hodgepodge or hodgepot? That's left over from Schedule D. We said it was passive income. I was just making an assumption here so we could play with this problem a little more, that this year was the same as last year. Do we put it in with those others? Yeah, we do. It's just passive income. That's why. Passive income, right? So then that would eat up what? Part of that 1,500 because the 30s are already netted out, right? So it nets, again, we're doing a net here, aren't we? Add all these together. we're at 15,000. I shouldn't have said 1,500. Negative. Now we're going to add that 6,500 positive. So that's going to give us what? 8,500 negative. What do we do with that? Isn't that this problem again? We'd have to allocate that now to what? B and C, right? 1/3 and 2/3, right? 15 over 45 and 30 over 45, right? 1/3, 2/3. Allocate that 8,500 loss to C and D. Everybody see that? Yeah. The key here to remember is that the passive activity, when sold, can generate passive income. Okay? Now we'll do one other thing with this problem, but let's check their model answer, and then we'll be over to chapter 7. Right? Desktop here, I think I've got it all down here in this folder, right? I should have my chapter 11 solutions. There they are. Make these a little bigger. There we go. All right. I'm looking for 43, right? Come on out. There we go. 43. There it is, right? First step, right? They added together, then they did the allocation, okay? As Yesenia and I did. Then they had that 6,500, and notice they're showing first the 2 coming out, then the 15. I think that's actually correct per the IRS's regs, right? On the order that you use that, okay? Now we said we would do something else yet before we leave this to go over to chapter 7. Let's go back to our board there. There we go. A new page here. All right, we had come down with what? D being sold. It had a 1,500 loss, right? And in the prior year, A, B, C, D, the prior year, right? D had a net 2,000 allocated to it. But B had what, 12,000, and C had 600. Those were the losses allocated, right? Last year, right? This is the continuation of 1143, all right? Continuing that problem. D had an operating loss, right? Now let's change this. Let's not have all that 10,000 income from selling D. Let's say we just have 0, right? That they walk away, right, from D. Okay. Now what happens, Yesenia? What do? We didn't create that 10,000 by selling D. We had what, a suspended loss, right? That was carried over. We had a current year loss. What do? That's the suspended and new loss, right? And what happens? You dispose of the activity, those losses become active, right? If you dispose of the activity, we don't have any income, right, to net them against here. So these become active losses, which means you can deduct them against anything, active income, portfolio income, right? And we're on our way, aren't we? There's nothing else I can put in there. I think that's it. That's the point I wanted to make. All right. Questions? Sometimes students will say, well, then what if this is all I have? I can't deduct those losses this year. What happens? It's the next chapter, isn't it, when we get to net operating losses, right? Yeah. Usually you're thinking of a Schedule C, maybe. These, they told us, were passive activity, I think partnerships, they said in this problem, didn't they? Yeah. And remember the partnership, if this is the trader business loss, K1, line 1, right? Yeah, that would be on the Schedule E, page 2, right? We talked about how these rules apply to the partner at the partner, right, in the partnership. Yeah, so that would become a loss. It would now become a net operating loss from an E rather than a C. Okay, C is most businesses. E, page 2 is the partnership or the S corp. And the next chapter 7 is going to tell us they changed the rules on the net operating losses for 2018. I think it's carried forward. I'm thinking it's indefinitely now. We'll double check that. Used to be carried back to forward 20, but I think the rule now is carried forward indefinitely. Everybody with us? All right. off to chapter 7, right? So this is what I say now. It'll be acct426Chap7 lecture, right? LEC, and then we'll probably get to some problems yet today. Huh? All right, I'll minimize this one. I want to go over to Blackboard, right? So I need Google here. And let's see, USB. It should get us into Blackboard. There it is. As we're recording here, we're in the 01 class, right? And they're going to use those videos in that 50 class. All right, let's see. Let's double check the syllabus, right? That should be down here in my folder. I think I'll make this a little smaller, right? There we go, that should work. And I'm just going to check the dates here so I can open up the solutions for chapter 7 as we're recording. It's 10:29. Chapter 7, the first time it appears on the syllabus in the live class, your homework is due the night before. Make it different, as I think I told you, in the online, because they're usually working on odd schedules, so their homework is due at the end of the week. All right, so in Blackboard, right? Chapter 7, it'll be under the modules. There. Module 7 is chapter 7. Okay. There's our folder, right? I want to download the PowerPoint. Open that up. And save it. Ugh. What? Every time I have this. Nope, eraser. Nope. It's maddening. State. All right, that's right away there. There's the save as. All right, put it down in the folder. Okay, and we'll also get the problems, solutions, and we'll also make these available to you. Yeah, the videos that are in here are from last year. They're all dated, right? I was hoping we'd have this year's videos in, right? We just got them loaded into the other course up to about where we are now, right? But they're unedited, right? So this lecture video is here, right? I don't think we've got. Yeah, so this is incomplete, so it should keep you from getting lost in the not working. But those videos are only bits and pieces, right? I just put them all together with some help. There it goes. From the people here for the other class, right? Maybe you could put them into there to see they have to be loaded into both classes. All right, so modules, chapter 7, there it is, module 7. Okay, and make these solutions available. Okay, let's see. There it is. All right, and then download these. File, save as. Okay. I'm in that same file. Okay, let's get into our acct426Chap11prob43chap7 lecture here now, right? Chapter 7 PowerPoint. And as I said, it says here certain business expenses and losses. This chapter has traditionally been about bad debts, right? 1244 stock, and then casualty losses. Now we'll talk about the casualty losses because they are still in the law. However, now, given the 2017 law effective 2018, you can only take that casualty loss if it's a personal casualty, if it's in a presidentially declared disaster area. Okay. Traditionally, those casualty losses could have been on the Schedule A, right? Personal casualties. They could have been on the C, for example. You have a CPA firm down in the, let me get off camera here just a minute. I'm going to shut this. So the casualties could be personal casualties on the Schedule A, but now they're only there for presidentially declared disaster areas. They could be on the C, for example, if related to the business. You have a CPA firm down in Temecula, the creek overflows and it destroys one of your copiers or computers. Yeah, be a Schedule C casualty. And there is an income-seeking casualty. I think that's still on the A under those other miscellaneous, right? That's still on the Schedule A even in 2018, where the gambling losses are. Yeah, I think they also put those income-seeking casualties there. Right? The other two smaller points that have generally been made in this chapter, smaller for our coverage, worthless securities. When do they go bad? And the rule they're going to tell you is they go bad the last day of the taxpayer's year. Now, somebody will get this wrong on the exam in real life, right? Because if you buy a stock and it goes bad, let's say you buy it in November, it goes bad the following May, okay? You're thinking, all right, but now I've got this worthless security rule. It doesn't go bad to the end of the year. If I'm a calendar year individual, that means 12/31. What does that change? What kind of loss is that? Is that a loss you can deduct? Totally worthless, let's say. Can you deduct that loss? Schedule D, right? Capital loss. What's the difference, though, if it goes bad the end of the year? What changes? What else is relevant to Schedule D? Holding period, right? Short terms on the top, long terms on the bottom. Yeah, it looks like it's a short term, right? Bought it in November, goes bad in May, but it's a long term, right? Because it goes bad the last day of the taxpayer's year. Remember that, right? It changes how you do your D, right? Short terms on the top, long terms on the bottom. You net your long terms together, you net your short terms together, right? You net the long and short terms together if they're opposite signs. Somebody's going to miss that. I can predict now, right? Should get some odds on that. All right. And the other point in this chapter is the one we just made in finishing chapter 11. Other smaller point for our coverage are those net operating losses. Now, those have traditionally been in the PowerPoint toward the end of the chapter. Let me see if I can pull that up. It should say net operating losses. Net operating losses. There we go. Carry forward only, right? Then they tell you it used to be back to forward 20. You're on slide 44 in the textbook's 2019 PowerPoint. General can be carried forward indefinitely, which I suggested to you. Limited to 80% of taxable income. That's new, right? That's new in the 2017 law. Okay, everybody's there. All right. One of the smaller points for our last chapter, we had that Schedule E, right? Net operating loss. Right? You could have a Schedule C net operating loss. All right, let's go back to the beginning here and do some of our lecture and then some of the problems here, right? All right, bad debts. All right, how does a cash basis taxpayer have bad debts? Usually from lending money, right? A cash basis taxpayer. Accrual basis, well, the receivables could go bad, right? Slide 7 in the 2019 PowerPoint for Chapter 7 tells us whether the taxpayer is accrual basis or cash basis. For tax, we only have the specific write-off or charge-off or direct write-off, right? No reserve for bad debts, right? For most taxpayers, they give you the exception for financial institutions. That goes back to what we talked about in Chapter 4 when we did some of the accounting on the when is it income, and then Chapter 6 when we talked about the deductions again, right? And for accrual basis taxpayers, the rules are not the same as they are for GAAP, right? And we said that there's the all events test, right? For the deduction side as well as the income side. And then added to the code was the economic performance test, right? Remember the strip miners, they wanted to set up the reserve, right? For future fixing of the land. And we said, even though they could meet the all events test, the code was changed to add the specific performance test, right? No reserve to fix the land or to fix aircraft landing gear, right? Or to deduct bad debts. Even if you're accrual basis, you only write these off when they go bad, right? Now, this says business bad debts. We're going to have business and non-business bad debts. Cash basis individual, we said you're going to have bad debts probably when they loan money. And most of the time, their bad debts are going to be non-business because the business bad debts are in the business or if somebody is in the business of lending money. Right? Now, if somebody lends, so if you've got a Schedule C business, okay, you can have a business bad debt in there. But for the individual just lending money, it doesn't matter that the other person used it in a Schedule C, right? The borrower, okay? It's still a non-business bad debt for the lender. Okay, and then we're going to see that has certain consequences. Unless that lender is an individual who's in the business of lending money, or something that comes up sometimes in tax too, the person lends to protect a job. Okay, but then you have to say, is he really protecting his job or is he doing that as an investor? Right? Difference. Okay, sometimes like dad works for daughter, dad's the only employee, not a co-owner of the business. Daughter says, Dad, I'm going to have to lay you off unless you loan the business some money. That could be a business bad debt. Okay, lending to protect his job. Now, what's the difference between business and non-business? Well, the non-business, okay, the business, let's start here, says you can have partial worthlessness. Want to talk about what that is, okay? And let's see, is this the next slide? All right, on business bad debts. Okay, that's still on partial worthlessness. What else did they tell you? They should have told us, that's 404. They should have told us that it's also an ordinary loss. I don't see it in those 4 slides. Okay. Somewhere, oh, there it is, right at the beginning. Partial and ordinary, right, on slide 7. What's the difference? Where ordinary loss is easier to deduct, right? The opposite in taxes to ordinary is what? Capital. Capital loss is harder to deduct. Remember that from Chapter 3? When you put that capital loss on the Schedule D, if you have a net capital loss, how much can you deduct on the front page of an individual return? How much capital loss can you deduct after netting? 3,000, right? 3,000 on the front page of the return. So business bad debt's a little easier to deduct. We don't get partial worthlessness. We'll talk about what that is in just a minute. But you do get ordinary loss. Now, how about non-business? They should give us some slides on that too. Okay, non-business, slide 11. Okay, defined as short-term capital loss, and it says in the year the worthlessness is known, which means what? No partial worthlessness. Now, what does that mean? All right, dad loans daughter money for her business. Dad's not in the business of lending money. He's not protecting his job. That's a non-business bad debt for dad. Let's say he loans her $90,000. Okay, daughter goes into bankruptcy. Bankruptcy court says, well, if we think you're going to get 10 of your 90. Okay, if it's a business bad debt, my understanding, sometimes the textbook differs a little on this. Okay, you can deduct the 10, right? Because we already know that that's, well, no, not the 10, the 80, right? Because they said you're only going to get 10. You could deduct 80 of the 90 as a partial worthlessness, okay? Even though we haven't really received the money and closed up the debt yet, right? If that is a, well, let me go back. That is if it's a business bad debt, right? If it's a non-business bad debt, dad's loaning that money into non-business bad debt, partial worthlessness not allowed. The bankruptcy court says you get 10 of 90. No deduction yet for a non-business bad debt. Why? Because no partial worthlessness. Business bad debt, we deduct 80. Non-business bad debt, we have to wait. That's what they're trying to tell you here on slide 11. Next year, the bankruptcy court closes up. They pay the 10, right? Dad deducts the 80 if he's a non-business bad debt lender, right? Okay. Which is probably what he is. And it's also defined as short-term capital loss. Probably on the 4797. 4797 has a mixture of ordinary and capital. And I think one time I kept saying that in class, and then one of the classes said, oh, let's look that up. We went over to the IRS's website and we put in non-business bad debt. And we were eventually able to find out, yes, it is on the 4797. And then eventually we'll go to the D, right? Because it's defined as non-business bad debt, short-term capital loss. Okay? If it's a business bad debt, dad deducts 80 the first year. And then the next year, if he gets the 10, okay, he doesn't have any further deduction, right? Because he already took his 80 deduction. And when he took that 80, it was ordinary loss. If it's a business bad debt, ordinary loss, much easier to deduct than a capital loss, which goes to the Schedule D, right? Has to be netted, right? And if you net to a loss on the D, only 3,000 to the front page, right? For individuals. Okay. All right. So that really gets us through. Now, sometimes, there'll be these questions. Is that really a debt? Well, when we're doing these hypothetical problems, if it says it's a loan, right? In real life, you might have to look, did dad get a note from daughter? Was there a payment schedule? Was there interest? Was it really a loan? Right? But here, we go with what they tell us if it's a hypothetical problem. If it says it's a loan, it's a loan. All right. Worthless security, slide 15. That's where they give you that rule that it goes bad the last day of the taxpayer's year. Okay. Slide 18, 1244 stock. Now, what 1244 stock? That's the code section, right? Sometimes the exams will say small business stock. And then you have to make sure they're talking about 1244, because small business could also refer to an S corp, right? So in this chapter, if they say small business, they probably mean 1244. Now, what 1244 gives you, and I remember this chapter is supposed to be about certain business losses. You have a loss on the stock, right? You pay $50,000 for it, and it all goes bad. If you have a $50,000 loss, okay, normally that's capital loss, right? We already saw limited utility, hard to deduct, 3,000 to the front page if you don't have any capital gains, right? Under 1244, if you meet it, and again, if we have a problem that says it's 1244 or small business stock, you've met the requirements, right? You get ordinary loss. Oh, that's easier. Right? Up to what? 50,000 per year, right? That's the limit, unless it's married filing jointly, then 100,000. So if you're investing in a new corp, right? If the client comes into your office, now we don't give investment advice unless we have the additional, credentials to do that. But we talk about tax consequences and cash flow, right, as CPAs. And the client says, oh, if, there's a startup, my friend, he wants me to invest in it. Right away, you should be saying, get the 1244 stock if you can, right? Because we're going to see there's a limit of $1 million on the amount of stock that is 1244 stock. And you want your client to get that because if it goes bad, ordinary loss, right? If it goes good and you hold it longer than a year, we've got long-term capital gain, right? Lower rates. Okay. In fact, if you did not mention that to your client, it might be malpractice, right? When you talk about malpractice, it's the ordinary standard of care for another practitioner in the same geographical area, right? You got to bring some of these things up. Now, what puts it into 1244? We're looking at slide 18 here in the 2019 PowerPoint. Here's the 1 million limit, right? And they tell you that the purchaser has to buy this, the original purchaser from the corporation. What does that mean? You can't purchase it in the aftermarket, right? The stock market. You've got to buy it got to pay for it with cash or other property, and you must buy it from the issuer. Okay, now there could be an underwriter involved, but that means from the corporation. And the owner has to be, let's see if they give us the other requirement here. That's slide 20. They didn't give us all the requirements. The owner has to also be an individual or a partnership. So those are, when they tell you it's 1244 stock, they're telling you those requirements were met, right? Issued by the issuer, right? You bought it from the corporation or an underwriter, number one. Number two, you paid for it with cash or other property. And number three, the owner of that stock is an individual or a partnership. Have to meet those requirements. It's in the code for 1244. And then you can get the ordinary loss up to 50,000 a year, 100,000 for married filing jointly. However, right, inside the corporation, the most that it can be is $1 million. They haven't changed that number in years and years and years, right? Now, one of the articles I wrote for Virginia Tax, I think I told you, one of the highest level journals I've been in, very highly rated journals, University of Virginia Tax Journal. It was about these issues, the 1244 stock. And I put in there, you know, that, okay, there's going to be more than $1 million issued, right? Potentially, but only $1 million of it is 1244 stock. And I've seen other people right now, you can only issue $1 million. Well, maybe they meant you can only issue $1 million of 1244, but the corporation can issue more stock than that. Now, how do I think, or know that I think my interpretation is correct? You can issue 10 million, 20 million, but only 1 million of it is 1244. The IRS in its regulations says that you should put a legend on the stock certificate. In the old days, you'd stamp it, right? That it was 1244 stock. So when we're telling your client to get that stock, that's what he wants, that stock certificate that's stamped, right? And that's the way they would do it in the old days. They'd stamp the certificate. All right. Ordinary loss, 1244 stock. We'll see in the one problem on this, it can have a very dramatic effect, much easier to deduct ordinary than capital loss. All right, losses of individuals, slide 22. And what we're going to look at here, I think it's code section 165, I think it's the loss section. We're going to look at the casualty losses, fire, storm, shipwreck, theft, or other casualty, right? Now look what it says down on the bottom of slide 22. They've done this with most of the PowerPoint. 2018 through 2025, right? Personal casualty and theft losses are deductible only if a federally declared disaster. So I could put on the exam, a federally declared disaster, then you've got to do these computations, right? And they might be back in 2026 in any event, right? The old days, I think I mentioned this to you earlier in the course, it's still on the Schedule A. There's a line there for casualty losses personal, right? In the old days, I could say, okay, car accident, right? Yeah, $10,000 of damage, the insurance company has a deductible, and they only pay you, and you end up with still $2,000 out of pocket, right? You know, that's a casualty loss that you could deduct, okay? But today, that car would have to have been ruined, what? In a presidentially declared disaster area, if you're going to take a personal casualty loss on the Schedule A. Okay. Now, again, there could be a casualty loss on the C, right? Business, or the E or the F. Could be on that other line, other miscellaneous, right? On the Schedule A for income seeking. Yeah, what would go on that line on the A? I think they still have it in the book. Madoff, right? This guy who was selling stock and then everybody lost their money, right? 2009, I think it was. It's that long ago already. The IRS put out a revenue ruling, revenue procedure, one of their pronouncements they put out. And they said the Madoff loss would be regarded as a theft loss, an investment theft loss, okay? Not a personal casualty. Now we're going to see, okay, now that means today we don't need a presidentially declared disaster area, right? And also the personal casualties, you take out what, 10% of AGI and I think $100 still? Check that number. But that comes out of the personal casualty, right? But if it's a investment casualty, it's on the A, on the line other miscellaneous, we don't have to take those out, right? It doesn't have to be presidentially declared, okay? All right. And we gave you the example of a business one, right? Your machine is destroyed by the creep. All right, firestorm, shipwreck, theft, or other casualty, right? The other casualty category, the IRS regs say sudden, unexpected, unusual. Sudden, unexpected, unusual. How about an earthquake? Sudden, right? Unexpected, unless you think you can predict like some of these people think. Unusual in California. So, but the IRS says, okay, that is a casualty, right? An earthquake. But again, we have to, is it personal? Is it business? Is it investment seeking? But it is a casualty. It's a casualty. The termites eating the house, right? Yeah. I think they still have that in the chapter here, right? It really depends on how fast they eat the house, right? Let's see, losses of individuals. I'm looking to see if they kept it in here on the termites. Mark this up over the summer. It looks like it. Looks like on page 7.7, there's some footnotes there, 11, 12, 13. Yeah, events that are not casualties. There it is. Bottom of page 7.7, they have it listed as 7-3A for the electronic book. Let's see. Examples of non-sudden events that generally do not qualify as casualties, all right? Damage done by termites, okay? Over a period of several years, some courts have disallowed. Footnote 11. Footnote 11 says CA2, that's the Second Circuit in New York. And then there's an IRS ruling there, okay? Then it says other examples that are not casualties, all right? No, they took out the fast-eating termites?
Still there.
Is it still there? Where is it?
Somewhere.
Other examples of events that are not casualties. No loss was allowed when the taxpayer's home declined in value. We're sliding down a hill. Similar taxpayer was allowed a loss for actual flood. No, I think they took it out. Yeah, they've got footnote 11, but they took out the one where they eat that house faster, right? Yeah, I went back to the older text. They had another footnote. If they ate the house faster, you might be able to take a casualty loss deduction. Now, if it's your personal house, and then you got a problem, right? Currently, because you have to have a presidentially declared disaster area. But if it's a business building, right? The service will argue about that. That's what the footnote 11 still says, right? The service says that termites eating the house is not fast enough. We had a real estate lady in the class one year. She, one of her clients, they should have gotten that inspection, right? They had a lot of termite damage, potential casualty loss, although you might have to argue with the service about whether it met the definition of sudden. All right. Let's see. Theft, slide 24. As we mentioned, it could be a casualty like Madoff. Sometimes the problem is when did it occur? And then they go to the year of discovery. This person might not realize that slide 25 tells you that the theft had taken place. Okay. Amount of casualty loss. Now this says non-personal, okay, business or production of income. Business is what, 162. Income seeking is 212. Slide 29 tells you the lesser of the decline in value or adjusted basis minus insurance. That's the usual starting point, right? The lesser of the decline in value minus the insurance. Now, if somebody has insurance and they don't make a claim, they still deduct as if they made the claim. The code says that, right? Now, remember, you might not get that much from the insurance company anyhow because it's often a deductible, right? Car, house, building, whatever. Notice what it also says on slide 29. For these, it says non-personal. So what does that mean? Business or income seeking, right? That if it's completely destroyed, you use the basis. What's basis cost usually, right? Although it says use adjusted basis. We're going to find out in chapter 8, you adjust the basis down for what? Depreciation. Right? All right. So decline in value or basis, whichever is less, unless completely destroyed. Now, how can you measure that decline in value? Sometimes the repairers, right, would give you the measure of the decline in value. What does it cost to bring it back? Otherwise, you do what? Fair market value before and after. Okay. Now, that's not a personal casualty, right? Personal casualty, slide 33. Lesser of decline in value or adjusted basis minus the insurance, right? So the same starting point, right? Lesser of basis or decline in value minus insurance, right? Now, business, we'd be done there. Although if it were completely destroyed for business, we'd use the adjusted basis. Personal casualty, we don't have that rule, completely destroyed basis. That's not there. We do have some other stuff for personal casualty. There it is. It is still $100, right? Take out $100 per casualty event, 10% of AGI for the whole year. So even if it's in a presidentially declared disaster area, you've got to overcome a lot here, right? We had the professor who had a room destroyed that he had an old computer and old furniture at home, right? And it really didn't qualify as a home office, okay? That home office test, I think, is, which chapter? That's coming up too, chapter 9 maybe. So he didn't have really a home office. It wasn't a business. So it was personal casualty. Well, first off, you start with current fair market value, right? You know, used furniture and a computer, not going to be worth much, right? And then if it's a personal casualty, you have to take out that 100 per event. So you could have fire, storm, shipwreck, theft, earthquake, all different events. And then 10% for the year. Now, I told him, well, your AGI is low as a professor, but still 10% of AGI. That usually wipes out the personal casualty. That $100, they changed it 1 year to 500. And it was the year of Katrina, because for years, like I would say in a class, oh, it's still 100, still 100, never changed it. Then they changed it for 1 year to 500, then they changed it back again. And they're telling you on slide 34, the current law now, so 2018 through what, 2025, it has to be, it's a personal casualty in a presidentially declared disaster area. All right. Don't usually do much with research and experimental. Now this excess business loss deduction, now this is new in the 2017 law. I've got a problem if I've got time to do it. It says if a non-corporate taxpayer has excess business loss, it is not allowed. Okay. Non-corporate. Instead, it is carried forward and treated as part of the NOL. All right. Excess business loss is defined as aggregate deductions for the years attributed to the business. Businesses, it's in the plural, right? So you could have a C, an E, and an F, right? It'd all be businesses. Less the sum of the aggregate income. All right. Less a threshold. All right. That's the excess. So now they're giving you what, up to 250 or 500. All right. So it's still a pretty big number. If you had small businesses, right, you could take that loss currently. Otherwise, if it's limited by that threshold, right, you're adding it to the NOL and carrying it forward. Remember the NOL carried forward, what now, indefinitely, right? You can use 80% in a year, right? Up to 80% of what? Not 80% of the NOL, but 80% of TI? That's what it said. All right. Non-corporate has an excess business loss, carried forward, treated as part. Okay, I already saw that. Limits the amount of non-business income that can be sheltered. Okay. All right. Was it 250 and 500 for married filing jointly? Yeah. 250 and 500 for married filing jointly. Okay. Applies at the partner and shareholder level. Okay. After the passive activity loss rule. All right. Slide 42. All new stuff, right? Then the NOL rule that we saw previously, double check 80% of what? Of the TI. Of the TI. All right. So that's what this chapter is about. Bad debts, 1244 stock, casualty losses. All right. And they have a couple smaller points, the NOL and the worthless security. And now we add to the NOL, sort of an offshoot of it, right? That excess business loss. Yeah, and they told you why they put that into the law, the excess business loss. Similar to Chapter 11, and it says apply it after the Chapter 11 rule, right? Yeah, so you get past Chapter 11, you're still limited because they don't want you to have a big loss that you can then deduct against other income.
The casualty loss, it's only deductible if it's a federal disaster area.
Casualty loss, if it's personal. Remember, the casualty losses could be personal, Schedule A, right? Could be business, well, it depends what business, Schedule C, right? Could be the income seeking, Schedule A, but where it says other miscellaneous, for the gambling loss.
But for personal.
Personal has to be a presidentially declared disaster area. But if I tell you that on the exam, then you got to do the computation, right? If it's in a presidentially declared disaster. All right, time to do some problems, right? Chapter 7. How are we doing on time? The clock here says 3:02, which means we have a max of about 40 minutes or so, like 45. All right, we'll at least get through the 3 that I traditionally do. Let's see if we can add some. They add to these chapters, and I have to figure out do I have time to cover all that. All right, I have to decide what to add and what to cut out. Back of the room, right? We have people helping with problems. Okay. Who else is back there? Let's see. Helen Valencia. All right, you're next. 10/29. Today's date. And what do we say? Problem is 28, 31, 33 first. Let me try. 28, 31, yeah, 38, 37. All right. And do writing board there. Also going to want our solutions. Potentially, there we've opened them up already, right? Yeah. All right. If you would, please, Helen, go ahead to Chapter 7, Problem 28. Read it, tell us how you got the answer, ask and answer questions, please.
Several years ago, John Johnson, who was in the renting business, loaned Sarah $30,000 to purchase an automobile to be used for personal purposes. In August of the current year, Sarah filed for bankruptcy, and John was notified that he could not expect to receive more than $4,000. As of the end of the current year, John has received $1,000. John has contacted me about the possibility of taking a bad debt deduction for the current year. Write a letter to John that contains their advice as to whether he can claim a bad debt deduction for the current year. Also prepare a memo for the tax files. John's address is 100 Tyler Lane, Erie, Pennsylvania.
We don't write the letter or the memo. We let people write a memo, or that's one of the requirements in Tax 3, right? As I mentioned to you when we were going over how to do the extra credit research and writing. That is due what, next Monday? Is it? That's the exam, yeah, a week from Wednesday, right? I think it's Monday is the extra credit research and writing. All right, Helen, it told us this was one of those unusual situations where he was in the business of lending money, right? So that makes this a business bad debt? Yeah. And then we can get what? Partial worthlessness, okay? Now he loaned 30. The bankruptcy court says, looks like you're going to get 4. He's only received 1. Now we'll see if they still compute this differently than I would. What do you think he could take this year as partial worthlessness? What could he take this year? He's got 30 as a debt. They say you're going to get 4. Seems to me he could take at least 26, right? Because they say he's got partial worthlessness. He's supposed to be able to collect 4, right? I think that should be the preferred answer. Now, if it's a business bad debt, is it ordinary or capital, the loss? Ordinary, which is easier to deduct, right? This is the way they wrote the problem. Let's look at their answer. Some of these answers, they never change. Some of them, they've eventually changed to what I think. And when I go to the continuing ed seminars, I try to find out what other people think. And often it's been what I was thinking. All right. Chapter 7 solutions here. Okay. And go down to 28. There we go. Oops. All right. What do they say? John's 30,000 load. His deduction is 25. I can't see how they come up with that number other than they showed us the math there, right? They say, yeah, 30 minus 1 minus 4. I mean, it doesn't make any sense. Unless after a while, sometimes I come up with the rationale for the book's answer that they're being extremely conservative, as the IRS might be, right? And maybe the service would say, well, you got one, but you might get 4 more, so we're only going to give you 25 as the loss now. But that's not what the facts say.
26 is right on second.
Yeah, it says 26. Yeah, that's what I would think. So, all right, so Cengage is agreeing with me. And then the question would be, okay, let's go back to our writing tip. What happens the next year? How about that, Helen? If 26 is the good number, right, as the Cengage now seems to agree with me, when we get to that next year, let's say he never collects anything else. What does he deduct the next year? 3,000 because he collected 1, right? Yeah. Okay. What if they pay him 2 more? What does he deduct? Just the 1. What if he gets 5,000? Now they told him he was only going to get 4, and he gets 5. What's he do then? He's over deducted, hasn't he? He's got to include that 1,000, right? That's over the 4. Ordinary or capital? He took an ordinary deduction, didn't he? So it's probably ordinary income then, right? Yeah. Why was it ordinary? Because they told us he was in the business of lending money, business bad debt. All right. Let's change this to a non-business bad debt. Okay. Given the same facts, the bankruptcy court says you can expect 4. He collects 1. This is normally what the situation is going to be if he lends her money, even if she uses it in a business. If he's not in the business of lending money, right, or lending to protect his job, we're here. Can he take partial worthlessness? Can he, if the bank, no, he can't do anything this year, can he? All right. Even though it looks like he's got a 26 loss, goes to the next year. Okay. And the bankruptcy court actually does pay him the other 3, so he collects 4 altogether. He takes the 26 loss that next year, doesn't he? Ordinary or capital? Defined as short-term capital loss, right? The code says that. So it goes on that part of the Schedule D, right? I think it starts out on the 4797, but eventually goes to the D, right? Short terms are up at the top. Everybody with us? This is an easier chapter, at least by comparison, right? Some of the other stuff we've done. Okay, going across the back. Is Cynthia back there? Cynthia not there? Valerie? Valerie, okay. Today is the 29th. All right. Valerie, if you would please, what is it, 2831, our next problem, I think? Let me see, let me check my book here. Yep, 31. Let me get a fresh page up here. All right, 731. Go ahead and read that if you would, please.
Shall an Esteban file a joint return for the current year they have the following items?
All right, go ahead and read below that. What is the question?
Determine their AGI for the current year.
All right, so this is a review problem, but this is the way this course works, right? Remember the formula? It was in chapter 3, the whole course was there, and then they go back to the formula and they keep adding, and that's what they're doing here. They want us to do AGI, but in light of new things that are in this chapter, all right? So, Valerie, let's start now with the list. Salaries,
120,000.
yeah, is that in AGI? That's included, right? And the way you'll see their model answer sets this up, they give you a couple of columns, right? And they're really giving you the old page 1 of the tax return. So it's probably now page 1 and page 2, right? Those half pages. Right? And then they give you another column in from that, which is really the Schedule D, right? All right. Next entry, please.
Loss on sale of 1224 stock acquired 2 years ago. Which is 105,000.
105 loss on that 1244 stock. All right. Where do we put that? They're married filing jointly, right? Where does that go? If we didn't have 1244, the 105 would probably be what? Capital loss, right? All of it. Where would we put it then? If you have capital loss, which schedule? D, right? Yeah. Now 1244 tells us met the requirements, and they're calling it 1244 stock, which means the requirements have been met. We've got 100,000 ordinary loss. Where are we going to put that here? Let's do our computation. Where's it going to return? Probably where? Front page, right? And again, I think they're using probably the 4797 to start that, right? But they'll put it on that, and it'll eventually end up on the front page of the return, the 100. It's limited to what? 50 per year, 100 for married filing jointly. Ordinary loss, right? And then where, Valerie, should I put the 5,000 that's left over? Where am I going to put that? That's on the D, isn't it? Right, those are losses, right? And that is what? Long-term capital loss, isn't it? Because they said it was on greater than a year. All right, next entry, please.
Gain on sale of 1244 stock acquired 6 months ago is 20,000.
1244 gain, all right, and it's short term, right? Only 6 months ago, 20. Where do I put that at least to start? Is it over on the front page or page 1 or 2? Think so? How about the D? Don't those capital gains and losses start out on the D, right? It said that is capital, right? Even though it's 1244 stock, it's the losses that are ordinary, right? The gains are still capital, right? But this is short term, isn't it? Short term capital gain. All right. We've got another entry. Go ahead, please.
Non-business bad debt at 19,000.
Non-business bad debt. Non-business. All right. And 19,000. Where do I put that? Schedule D, right? It's a 19,000 loss, which is defined as short-term capital loss, right? Now, what happens on that D is the short terms are netted together right at the top of the D. That gives us what? A +1, right? The long term is netted against that because they're opposite signs. That gives us a -4. What do I do with that, Valerie? What do I do with that -4 that's on the D? 3,000 to the front page, right? Against other income? Yeah. So the model answer in the book should tell us 120 minus 100. That's the ordinary 1244 loss. Minus the 3,000, which is the capital loss that goes to the front page. So that should give us 17,000 of AGI. Now let's check that, and then we'll change this a little bit. Okay. All right. So that was what, problem 31. Yep, we came up with the 17, right? Okay, everybody's there? All right, let's go back, Valerie, to that problem and change it a little bit. All right. What would happen if that stock were not 1244 stock? Where would that 100,000 loss be? Wouldn't be ordinary here on the front page. Where would it be? Back over here, wouldn't it? On the D. If it's not 1244, 1244 makes it ordinary. Now you have 105 of long-term capital loss, right? We've got a net short term of +1. We net the long term and the short term together if they're opposite signs, right? So if we change it that way, we'd have a net loss on that D of 104,000, right? What do we do then, Valerie? If we have a net loss of 104 on the D, how much goes to the front page? Still only the 3, right? Now we don't have that 100,000 there, do we? That's what I was saying. Look how dramatic the difference is in the effect on AGI, right? You've got 117 on the front page instead of 17. Now you might say, well, it's only timing. Yeah, but if you can only deduct 3,000 a year, right, of that 100,000, what's that going to take? 33 and a third years? You'll be into the 34th year. So if your client, you didn't advise the client, oh, try to get that 1244 stock, might be in trouble, right? They used to have a problem in the book on these bad debts, similar, right? Because they're defined as short-term capital loss, where the good brother lent the bad brother 100,000, right? And it's for legal fees. And the bad brother gets convicted, he goes to jail, he's not going to have much prospect of paying back, and it was a loan, not a gift, right? So what's the good brother do now? can he deduct? It's a short-term capital loss, isn't it? If it's a bad debt that's not a business. We're back to like this problem again, aren't we? 3,000 to the front page, 33 1/3 years to deduct that. If it's indeed a debt, right, not a gift. Everybody there? All right. 8, I think, is my next one. Let's see. 38. No, 38? Yeah, 38. Numbers right here. Let's see. Chapter 7. Chapter 7. 28, 31, 33. 33, then 37, 38. I left 33 out. I need that one, right? 33 is the casualty loss, right? All right. Who else is in the back? Is Minerva back there? No. Has everybody in the back had a chance to do a problem? All right. Okay. We're back to the front. We started on this side. 2 people who are over there, aren't they? Well, you were on this row first anyhow, right? Who did the, where did we start though? We started on that side? Did we really? Oh yeah, everybody's pointing over there. Did we start over there? 926, yeah, in this front row. Tori, right?
I think you started with that.
Yeah, no, you want to start over. I think we got to them later. I put them in the second row. Yeah, because they were, oh, Josh, where's Josh? Yeah, okay, all right. You started the very first day, right? All right, can you go ahead to this chapter 7, problem 33, please? Get another page here. And so we're on 7, 33. Josh, you got all the way around the room, huh? Today is the 29th, right? Go ahead, if you would, please, and read problem 33.
Olaf lives in the state of Minnesota. Tornado hit the area and damaged his home and automobile. Applicable information is as follows.
All right, we'll come back to that. Let's see what it says below.
Because of the extensive damage caused by the tornado, the president designated the area a disaster area.
All right, so we know it's the presidentially declared disaster area, and it's his home. All right, in auto, they didn't tell us these were business, right? It sounds like personal. Okay, go ahead and read what else is below there.
Olaf and his wife, Anna, always file a joint return. Their 2017 tax return shows AGI of $180,000 and a taxable income of $140,000. In 2018, their return shows AGI of $300,000 and taxable income exclusively of the casualty loss deduction of $215,000.
Okay.
Determine the amount of Olaf and Anna's loss and the year in which they should take the loss.
All right, so we're going to go back and figure out the amount of the loss here, because that's usually what we have to do. We have to get that right starting point, take out the insurance. If a personal casualty, take out the 100 and the 10% of AGI. What about the year here? Usually the year the casualty occurs, stuff like the year of discovery. Why are they giving us a choice here?
Provide immediate relief for the first year.
When do you get that choice, though? It has to be what? Presidentially declared disaster. That rule was there before they changed the rule that said it could only be deductible if it's a personal casualty in a presidentially declared disaster area. Before they changed that rule in 2017, effective 2018, there was this choice, right? That you could put the loss in either year, last year or this year if it occurs this year, right? And yeah, exactly for that rationale, that maybe you'd get the refund quicker, right? Take it, and maybe have more income in that prior year if the loss affected your income in this year. So that rule was there before. Presidentially declared disaster area, you could take it the year it occurs or the prior year. All right.
Isn't it still there? So
Yeah, that's still there. That's still there, but it was there before. Yeah. All right. Now let's go back and figure out how this loss occurs on the house. All right. You can get a schedule like this that you might have to make up yourself, or it could be on the exam. He's got what? Home, car. We've got the adjusted basis there. $350 for the home. The car is $60. We've got FMV before, you got FMV after, and then we've got insurance, right? FMV before on the house is 500, on the car is 40. Okay, FMV after on the car is 10. On the house, it's only 100, okay. And then the insurance, 280 on the house, all right, 20 on the auto. Let's do these as if we only have one of them at a time, right? Let's look at the house. What's our starting point on the house? Supposed to be what? Decline in fair market value, which is like 400 here, or the basis, 350, whichever is less, yeah. So we start with 350, right? It's Josh, right? Am I saying that right? Yep. Okay. 350, and then subtract the 280, right, for the insurance. Okay, now, if there's a personal casualty, we know we have to take more out, right? If it's a business casualty, we'd be done right here, wouldn't we? We'd have a 70,000 business casualty. Which business? Well, if it's associated with the Schedule C, right? If it's a theft loss, then it was an investment theft loss on the A, but in other miscellaneous, we'd be done here, right? How about on the car? Okay. Decline is what? 30. Basis is 60. We'll use the lesser, right? The 30 minus the 20 insurance. Okay. So now we've got a loss of 10 on the car and a loss of what? 70 on the house. Okay. Total loss of 80. What else do we have to take out?
Insurance proceeds from the car.
We did already, didn't we?
Oh, yeah.
Yeah, we did right here. Okay. Got to take out that 100 per casualty event. Now we had one event here, right? It was when it was a tornado, right? Okay. And then we have to take out the 10%. Now this is going to make a difference, right? For the year we put it in. Yeah. Because if we put it in last year, it's 10% of AGI. That would be 180, so it'd be 18,000. 10% of this year would be 30,000. Now he's in different tax brackets, isn't he, right? If we go back to that front flap of the book, let's see if we can find that here somewhere. Show desktop. Put it in here somewhere. There it is. Okay. Yeah, there's our tax rate schedule. Make this any bigger. There we go. What was TI? Let's see. Last year was 140, was it? And this year is 215. So last year on married filing jointly, 140, like a 25% bracket here, right? This year, married filing jointly, okay, and the TI of 215 would be a 24% bracket, right? Actually be a slightly lower bracket, all right? Which means it would save a little less when you take the loss. Oops, looking for my, there it is. But the problem is this year we'd lose a lot more of the loss, wouldn't we? We'd lose 10% of 330 instead of 18, a $62,000 loss here, right? If we take it last year, is going to be better than a what, 50,000 loss, right? Even with that just 1% difference in tax rate. Plus, you can get the refund quicker, right, if you take it last year. This time when we take it this year, it's the higher income that's causing a lower loss. Often that wouldn't be the case because you might have lower income. So it looks like better to take it last year, right? Now they might put time value of money in these problems. I haven't done a lot with that in this class because they just started putting them in the book. Time value would say taking the loss sooner, and getting the refund, right? Yeah, it would probably be better. Plus, we're going to get a bigger loss. Now, let's look at their model here for 33, right? 33. Okay, there they're showing the 100 out, all right? And then what? Last year they took 18, this year they take 30, okay? Tax savings will be, yeah, look at, not only is the tax rate slightly higher, 25% last year, but the loss is much bigger, right? Yeah. So the savings was 15,000 plus versus about 12. Okay, so much better than taking it last year. They didn't even put the time and value money in the answer this year. Did last year. All right, so know how to do this problem, right? Here it was written as a personal casualty. If I changed it to a business casualty, you wouldn't take out what, that 10% of AGI and that 100. If it's a business casualty, let's go back and look at the numbers. Okay. We didn't have anything completely destroyed, did we? It didn't go to zero. If we had completely destroyed and it's a business or income-seeking casualty, you're supposed to use the basis, right? Yeah, adjusted basis probably is more technically correct because it could be adjusted for depreciation, for example. All right.
For the personal casualty loss on that, like you could take it as 2017, 2018, but you wouldn't know your AGI from 2018, so
Till the year's over.
Like wait till 2019 to see which one to pick.
Yeah, well, you'd be wait till the end of 18, so you'd almost be in 19. The way you're going to take it back in 2017 is it's going to be an amended return for 2017. Yeah. So you're waiting, and you've got 3 years at least to amend your return usually. Yeah. Chapter 26 in tax 3, we talk about how far back can you go and open up a year. Usually the IRS can go back 3 years on a audit, and usually taxpayer can go back 3 years on a refund claim. General rule. Some other special rules and statute of limitations, right? How far can I go back? All right, other questions or comments? All right, let's check out what we have left. Where's our clock here on the computer? Question? Yep.
Can you show the table on the tax table?
The tax table?
Yeah.
Okay. That, yeah, I got that out of the that document, which comes either from the appendix or the front flap of the book. I'm trying to remember where it went to now. It was this, right? Okay, which year did you want to see, 18 or 17?
I just want to see
What it looks like?
Okay, yeah.
Yeah,
Thank you.
yeah. This is the one of the two front flaps of the book, or it's in the appendix right along with the formula, right? The tax rate schedules. And again, we use the tax rate schedules for problem solving in class. If you're doing the tax returns, remember there's a tax table in the instructions, right? Up to 100,000, right? 100,000 or more, you're supposed to use the rate schedule. Okay. All right, how's our clock running here? 3:30. All right, we got 10 to 20 minutes depending. All right, I've got to do something new that they added here, right? Yeah, the what do they call it? The excess business loss, right? Okay, so we're moving this way. Somebody's changed seats on me.
Yes, I changed.
Brady, right?
Yep.
You want to do this problem, Brady? You ready?
We're at what, 37?
30. Yeah. What's my order on these? I put them in some kind of order on purpose, I think. Look. All right. You can see this is, again, as was mentioned, probably easier, at least by comparison, if none of these chapters are easy, but easier than 11 for sure. All right, but I try to, like on the second exam, weight the points relatively equally between the chapters, right? True, false, and multiple choice and problems. All right, I put 38, then 37, then 38. All right, so go ahead to, both of these I think are this excess business loss. If they're short or related, we might ask you, Brady, to do both of these. Today is the 29th, so let me get another board up here. There's my board, there it is. All right, new page. Okay, and this will be 737. Go ahead and read that if you would, please.
During 2018, Liesel, a single taxpayer, operates a sole proprietorship in which she materially participates. Her proprietorship generates gross income of $142,000 and deductions of $420,000,
Okay,
resulting in a loss of $278,000. The large deductions are due to the acquisition of equipment and the use of immediate expense and additional first-year depreciation to deduct all of the acquisitions. Can Liesel use all of this loss to offset other income she has?
all right. Where is this on the tax return? What schedule or where would it be? It says it's a sole proprietorship. Where do you put most businesses? C, right? Yes, it's probably Schedule C. And they're giving us what's written on that C. And the bottom line is net loss. Now, normally we would have put that on the front page. They told us something else out of Chapter 11 in this problem. They said material participation. Because remember, that's relevant to a C, even if it's not real estate, right? So because our passive loss rules could stop us, passive loss is only deducted against passive income. We don't have that. So we're thinking, ooh, we can take 278 on the front page, right? But now we have a new rule, right? Excess business loss. Yeah. How much can she deduct?
$278,000.
That's what we would like to deduct, but let's see. Yeah, excess business loss. Slide 40, 250, right? 500 for married filing jointly, 250 for everybody else. So she's going to lose, at least for now, 28,000. Yeah, what do we do with that? What do you do with that? They told us. Let's see. Yeah, instead it is carried forward and treated, we're on slide 40 in the PowerPoint, part of the taxpayer's NOL in subsequent years, right? Yeah, indefinitely carried forward, only up to 80% of TI in the future year, right? Okay, now, a good question of which ones do you use first? And it doesn't matter if it's an indefinite carry forward, right? Now, let's see. Let's look at their model, and then I might ask you, Brady, to do the next one. We'll see how. What they're really just trying to get across to you is there is this new rule, right? All right, Chapter 7 solutions. This was 37. 37. Okay, 28,000 and carried forward. Yeah, so 250 is the most she can deduct on the front page, right? So then we're looking at that front page and seeing if she has any other income. Now, if she's a partner in an accounting firm, or she's a sole proprietor, maybe she's got another Schedule C, right? Or she's a salaried employee, all that income's coming to the front page and she wants to use this against it. Oh, there was something else in this. Yeah, they're looking ahead to Chapter 8, our next chapter. They said the reason she had so much loss was it was deductions for doing a 179 write-off. I think it's up to 500,000, or they've adjusted it even higher now. You can expense, right, instead of capitalizing and depreciating. And there's first-year bonus depreciation too. Depreciations, you could be borrowing to buy the assets, so it's not cash out of pocket, and you could be deducting the interest too. That's the essence of the tax shelter, right? Back in Chapter 11, that's why the people were investing in the real estate too, right? And that's why they came up with the PAL rules, because they said, oh, you're just investing in non-economic investments to get the losses. Now, thanks to Trump's 2017 and the Republican Congress, right, the 2017 tax law, we not only have to get over the basis limit, get over the at-risk basis limit, get over the PAL limit, right? Now we have to get over this excess business loss. So depending on how much other income she has on the front page, she might not even be able to use that full 250, right? Yeah, that would become part of the NOL also then. Okay, carrying forward. All right, Brady, let's look at 38 and see if there's much more in there. Looks like it's another short one, so go ahead if you would, please.
Timothy Gates and Radha Singh decide to form a new company, TGPS LLC, a multi-member LLC that will report its operations as a partnership. Timothy is married and Prada is single. Each contributes $400,000 of capital to begin the business. And both materially participate in the business. In 2018, TGPS reports a net loss of $580,000. What are the implications of this loss for Timothy and Prada?
All right. How much loss is allocated to each? It's a LLC treated like a partnership. This goes back to when we did that simple problem on partnership in chapter 4. They assume that that they're equal partners unless otherwise indicated. And we have what? Timothy and Prada. Tim, Prada. So probably going to be allocated what? What's half of that? 290? 290,000 each, right?
Yeah.
Now, we were just talking about those limits. So that 290 appears on the K1 because they treat this LLC like a partnership, right? Each has a capital account starting at 400, so they got plenty of basis, don't they, to take that loss, right? The capital account, if using tax numbers, would equal the basis here. And if they were at risk, they'd have the at-risk basis. Did they say they materially participated?
Yes.
Yeah, so we've got past the PAL rule, right? Now we're to the new rule, right? The excess net business loss. How about for Timothy? How much can he deduct? He can go all the way to 5, right? Because he's married. He's only got 290, right? So he can deduct the 290 if he's got enough income, right? Okay, otherwise it's an NOL. How about Prada? How much can she deduct in light of that what are they calling it? The excess business loss rule.
She's only got 250, right?
250, yeah. So she's already got a 40,000 limit, which goes where? Or 40,000 is limited. Where does that go?
Carry forward.
Carry forward as a
NOL.
NOL. That's part of that.
What does that stand for, NOL?
Net operating loss.
Okay.
Net operating loss. Okay. And then she has to have 250 in income, right, or something. You have to take that 250, or she'll have more NOL. Right? More. All right, let's look at their model here. And we're about done for today. We've been efficient again. Looks like we'll come in right at about our quitting time, even with the new problem. Right? What happened? Fast. 38 this was, right? There's 39, 38, all right. What did they do there? 420 minus 142 minus 250. That's 37? Oh, here it is. Yeah, I got this thing in the way. Can't get this thing. The same problem with this thing all the time. Get out of the way. 38. There we go. All right. Schedule E, page 2, right? If it's a K1 from a partnership or an S corp, 290. All right. Tim can use the full 290. Prada, already limited. Okay. It's part of the NOL. Both of those are relatively simple problems, but they wanted to enforce, and the reason I picked those, the new law here, right? So we only have one other new law problem that we haven't gotten to. That was that, remind me, the one number was a 37 in chapter 6, which is the qualified business income. And I think they give us a simple problem on that. It gets harder in chapter 15 and tax 3. So we're right on schedule, right? Quitting time today, Wednesday, it'll be, maybe I'll try to do that one problem, and maybe I'll go to chapter 8. I got to go to 8. I have to go to 8. Got to do a lecture on 8, and then we might do a problem or two, and then the exam preview. Right. Let me put something up here that may be useful to you. And that is, in chapter 8, which problems do we usually cover in class, right? In chapter 8, we usually cover in class 35 and 40. And if I do a couple of problems, that's the ones I'll probably do if I have time. And then 41, 42, 46, 47, 52, 53. 8 is depreciation, right? Tax depreciation. And these first two problems are the depreciation system, MACRS, personal and real estate, right? 41 and 42 are the 179 write-off, right? I'm looking to see if I had the number written there. I don't see. Oh, 520 maybe this year. 46 and 7 are the cars. 52 is ADS, which is another special depreciation system. And 53 is 197, not to be confused with 179. That's amortization of intangibles like goodwill. Okay, that's what. But what we'll do on Wednesday is lecture on 8 and some of the problems. But I'll stop so I can do the exam preview. Right? Exam preview on 6, 11, 7, and 8. Okay, because we'll still have Monday to clean up problems. Right? Chapter 8 and maybe that one back in chapter 6. Okay. All right. Let's stop for today. All right.
Question, you know what's the name for tax 2?
Oh, tax 2. That's corporations and partnerships. Yeah. See you Wednesday. Thank you to all who participated today.
Can you go to one of your notes? It's like
Okay.
the third one,
All right.
or I think it's the first problem. The first problem from chapter
This one?
11.
Chapter 11, yeah. Okay.
You said the 85,000, but it was like for next year.
Oh, if we 8,500, yeah.
Oh, yeah.
If we change this and we said, all right, instead of selling this for 10, they get nothing, right? Did I have another page that I didn't?
I think you just stayed on that.
There it is.
Oh.
They said, what if they got 0? They had their 1,500 loss. Oh, wait a minute. You're talking about if they had income.
And then you said that they would allocate it to
These two,
B and C,
right?
because D is
This is
already
D's
done
gone.
from last.
A's not a loss activity. You allocate the net loss, you add these together, and we added the 6,500 that's left. So that gives us a net 8,500 negative. That's allocated to the loss activity by a ratio of the losses, 50 over 45, 30 over 45. So
And
that's
you
1/3.
multiply it by the 8,500.
Yeah, 1/3, 2 digits. Okay? All
Thank
right,
you.
you're welcome. Okay.
So I was like, people in my next class.
Good stuff. I see the cloud is still up there. Thanks.
Yeah, we got like, what, 5 people?
Okay.